China's latest report on factory activity contracted for the fifth straight month in August, but managed to top expectations. Our next guest has new data that is telling a more upbeat story about the Chinese economy. Joining us now, China Beige Book International COO Shehzad Qazi. Joining us. Appreciate you for joining us this morning, Shehzad. So it's been a pretty steady drumbeat of somewhat disappointing economic numbers, both on the manufacturing side from China, as well as the consumption response to a reopened economy. What are your numbers telling us?
Yeah, look, I mean, in recent weeks, there's been a pretty scary consensus building that the Chinese economy was on a verge of a collapse. And the latest data out from our surveys pretty clearly showed that's not the case. Consumer spending has been much more resilient than markets have realized, specifically in the travel and leisure sectors, the dining out component. But even retail sales seem to be on track for an August rebound, with luxuries looking good again, car purchases, furniture and appliances, and so forth. The problem within the Chinese economy seems to be concentrated within the property sector, and that's, I think, overshadowing what otherwise may be a bit more positive of a China story this month.
Is the property sector, though, not a broader overhang on the economy? I mean, it seems not just because people are concerned about potential leverage in the system and some of the systemic issues, but just because it seems like perhaps it's causing less aggression among consumers to spend than it otherwise might. You hear the authorities there trying to stimulate a little more consumption than they're getting.
Yeah, look, the property market is certainly a drag on growth this year, but the property market story is going to be with us for, I think, at least the next couple of years, where we get more bad news potentially on the developer front, with potentially more developers looking like they are going to be missing payments, going under, and so forth. And I don't think that purchase sentiment around homes is going to be revived that rapidly. So I think this remains a negative China story that investors have to deal with for the next year or so.
What do you make of the various policy responses? It seems like, most days we wake up and they're changing rules about stock trading or taxes, or attempting to try and speed up the activity there. Do you think they'll be effective?
What we've seen this year on the policy front is continuous support, although, of course, very moderate and modest efforts, as opposed to the market's desire for big stimulus rollout. The impact, I think, will be marginally positive. It is worth mentioning that one of the clearest places where there has been a lot of policy support all year long but gone unnoticed is on the monetary side. You've seen credit costs fall essentially through the course of the year. The most important thing that's happening now, of course, is that companies seem to finally be coming off the sidelines and looking like they're interested in borrowing. So we may potentially be seeing a turn there.
We obviously just were tracking Commerce Secretary Raimondo's visit to China. It seemed like there was a relatively constructive feeling that was left by the series of meetings and by some of the commentary around it. Do you think that there is some kind of more stable trade relationship that is developing at this point, and how is that being dealt with domestically inside China in terms of their investment in export-led growth and such?
Yeah, I don't know how much of that will stabilize the trade relationship, which seems to have found, quite frankly, a new normal anyway since the onset of the trade war, 4 or 5 years ago at this point. But I think the most important thing is on the U.S.-China geopolitical front, it looks like the Biden administration has basically, we've seen peak China policy coming from them. More muscular, aggressive action is not, coming down the pipeline anytime soon. That said, there are certainly many pieces of legislation that are making their way through Congress, which will, I think, continue rattling markets and keeping investors a little bit on edge when it comes to the geopolitical tensions and the decoupling fears between the two countries.
Shehzad, we had a guest on yesterday who said that if China slows down, it's not necessarily going to have impact on the U.S. economy. But if China slows down, it will have some impact on the globe. How do you try and figure that out, or what are your thoughts on that?
Yeah, I think the clearest impact is going to be and will remain on the commodities producing countries. They will be the most impacted. specifically as we discussed as it relates to the property sector and the construction slowdown out in China. But of course, the big, more mature economies like Germany and Japan, even South Korea, they all suffer because they all do, have important trading relationships with China and depend in part on Chinese demand. So there is no question about the fact that there are global ramifications of a China slowdown. Of course, on the other side of it, the Chinese economy is incredibly sensitive to a slowdown in the Western economies. We're already talking about a slowdown in recession fears out in Europe. So there is that feedback loop that is probably more important.
Do you think the rebound in travel activity in China is going to be sustainable? There was a lot of talk here, of course, that there was revenge travel. It was going to be a brief period, but then it actually has persisted for a couple of years.
Yeah, I think, we would probably for the year are at about a peak. I don't necessarily expect it to get any better. We are seeing quite a strong recovery in that sector. The real question, I think, for us remains, can we get Chinese consumers to broaden out their spending from things like travel and leisure to a more sustained pace of growth with things like autos, with things like luxuries, which are incredibly important. And of course, can we finally start getting buyers to come off the sidelines and move into the housing market later this year and as we get into early next year?